This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we've gone through and consolidated a subsidiary whereby we have a 100% equity stake within it, but that's not going to be realistic within the exam. The likelihood is that you will own greater than 50 but less than 100%, and if that's the case, because you own greater than 50%, you will still go through there and have control. Okay, that's the key bit. Greater than 50% of the equity share capital gives you control. However, in the previous examples, we saw 100%, and we consolidated the assets, the liabilities, 100% on a line-by-line basis. But that's where you need to be careful, because if you still have 75%, you still have greater than 50, so therefore have control and the power to direct the activities. So you have a parent, you have a subsidiary, you have a group scenario, and therefore must prepare the consolidated financial statements. Just be careful though, if you have control, you will go through there and consolidate the assets and liabilities 100%. I've said it once in the previous video, I'll say it again. Do not put in 75% of the assets and 75% of the liabilities. If you do, you may as well just give up on the rest of the question. Okay. But what we need to do is, given that we put in 100% of the assets and 100% of the liabilities, how do we then deal with the fact that we don't own all of the assets and all of the liabilities? We have somebody else that owns a 25% interest in the subsidiary. And that 25% interest is referred to as the NCI, the non-controlling interest, NCI for short. And what we go through and do is, if we go back to the example that we saw before, here in terms of the assets, the liabilities, that shows control. Within this section here, within the equity section, that's whereby we show ownership, isn't it? So when we were talking about the group retained earnings, we spoke about what the parent owned, and they owned 100% of their retained earnings, and then they owned their share of S's post-acquisition retained earnings. So here, we're now going to put in 75% of the post-acquisition retained earnings. And the other 25% that we do not own is shown also within the equity section of the consolidated statement of financial position. So you're going to have share capital, share premium, retained earnings of the group, which will then total up to show what's attributable to the parent. Then we'll have a separate line item that says non-controlling interest, before we then add that together to give you the total equity within the business. Okay. Now we need to be careful, because there are two methods to which we can go through there and value the non-controlling interest. And the first one that we're going to look at there is the proportionate share of net assets method, whereby we just go through there and work it out as the non-controlling interest share of S's net assets at the reporting date. If we've gone through and consolidated all the assets and all the liabilities 100%, we've consolidated the entire net assets, but we don't own all of them. So what proportion do we not own? We do not own the non-controlling interest share. So what we will go through and do there is that we will go through then and show that non-controlling interest share of those net assets as a separate line within equity. Okay. Don't worry about the fair value method just yet. We'll discuss that afterwards. What I want to do is I want to go through there and use example number 3, okay, to work our way through how it all pieces together, okay. And what you'll see working, or example 3, is very, very similar numerically to what we've done in terms of example number 2. So let's have a look at it. So what you've got here is, again, it wants the consolidated position statements for the peer group. So peer is the parent. It's wanted at December X5, so that's our reporting date. And it says, assuming the non-controlling interest is measured using your proportionate share of net assets method. Okay, it will state specifically within the question which method you're to use. In practice, you have choice, and you can make a choice on an acquisition by acquisition basis whether or not it's the proportionate share method or the fair value method. So what have we got? It says Pierre acquired 80% of the equity share capital. So we have control. We own 80. The NCI own 20. And we're told that that took place on the 31st of December X4, when the retained earnings at that acquisition date was $750,000. You're told there about the financial statements. So again, what you've got there is that the investment in Stefan being the subsidiary, we can go through that and ignore it, can't we? Okay, because we're going to replace that investment on a line-by-line basis with the assets and the liabilities of the subsidiary. If you're curious as to why it's fallen from 1,000 in the previous example, effectively we're buying less, so we're paying less. Okay, so what have we got? Let's go through there and prepare this group statement of financial position. So we're going to go through there and start off with, is it the assets? So your other assets, 1,900 and 1,450. If that's the case, we add them across, and it gives me 3,350. So again, approaching it in the same way as before, just looking at the total assets, looking at the liabilities at the bottom. What I'll do is, just to give myself enough space, I will make sure that I put in the other sections as well. So do we have share capital? Do we have your retained earnings? Leave a line, you will see why in a moment. And then we put in the NCI. And then once you've got the NCI, you will then go through that. Leave a line for the subtotal. We will then put in our liabilities. Our liabilities, I can't remember what they were, so I'll go back and have a look. You've got, is it 500 and 300? So just use small bracketed workings, what you can do within the exam. That gives me, is it 800? Okay, and I know at the end it should total 3350. If it doesn't, you've done something wrong. Okay. Share capital, remember, that's always 100% of the parent. So here 100% of the parent is there as 1,000. And then what I'm going to do is I'm going to do separate workings for the retained earnings and the non-controlling interest. Okay. So let's go through that and look at the group retained earnings first. So remember, that's 100% of the parent. And then we add on P share of S's post-acquisition movement in those retained earnings. So what have we got? Let's get the easy marks first with 100% of the parent. So is that 1,200? And here we own 80% of S. The post-acquisition retained earnings, well, at the reporting date, that figure was 900. And at acquisition on December X4, it was 750. So that's the 900 less the 750. 900 less 750 is 150, isn't it? 80% of that is 120. So the group retained earnings are there 1320. Retained earnings 1320. If I total things up there, that gives me the amount of equity that is attributable to the parent, adding together the share capital and retained earnings. The non-controlling interest, you could cheat and work it out as a balancing figure, but let's not. The non-controlling interest is based upon your proportionate share method. So here, that's going to be, isn't it, the non-controlling interest share of S's net assets at the reporting date. Well, the non-controlling interest share is 20%, so that's quite easy to do. The challenge is looking at the net assets. And the best way to go through and look at it is not to look at the individual asset line and deduct the liabilities line, because in the exam, it just gets too complicated. You'll have lots of assets and lots of liabilities. So what you need to go through and do there is look at the equity section. The equity is equal to assets less liabilities, so is equal to your net assets. And what you've got there is that 250 and 900. 250 and 900. So what you've got there is the share capital and the retained earnings. If you tap that on your calculator, 900 plus 250 is 1150. 20% of that is 230, isn't it? Okay. So that's what the non-controlling interest own. We've gone through there, haven't we, and consolidated all of the assets here at 1450, all of the liabilities at 300, and of that figure there, I think if you net it off, is it the 1150? 20% belongs to the NCI, and that gives me 230. Okay. If I add that to the 2320, does that give me 2550? And then when you add it to the 800, gives you, yes, brilliant, the 3350. You get a little glow, a little buzz within the exam when everything balances and it all works out correctly. Okay. So what we've gone through and done there with that example is worked it using this proportionate share of net assets method. But what you can also use as well is the fair value method. So we're at the moment basing the ownership of the subsidiary and what the NCI own based upon the book value of the assets and liabilities. Okay. We would have to value them up to what they're really worth, but we'll worry about that later on. What we can do is effectively look at the NCI based upon the fair value. The fair value of what? Well, the NCI own their percentage, so 25% based on that page, 20% based on the previous page, isn't it? So they own the non-controlling interest of the share capital, don't they? So what we can go through and do there on the fair value is take the non-controlling interest share of the number of S's shares in issue. Okay, so if there's 1,000,000 shares, your non-controlling interest percentage of those 1,000,000 shares. So if it's 20%, 200,000, 25%, 250,000, then what you do is you then multiply by the share price of the subsidiary. So by S's share price, because that effectively is the fair value, isn't it? That's showing what S's shares are worth. We know how much the non-controlling interest owns of those shares, so we can put them in at their reflective market value, at their fair value. So instead of in that previous example, looking at it based on the proportionate share of net assets, we could go through there and work it based upon S's share price. But using that fair value method would require us to be given S's share price, and we're not within that example because it would just get a bit complicated before we introduce this concept of goodwill. But I think it's important at this point in time to make sure that you're happy with that example on the non-controlling interest, and to make sure there that you know the two methods of being able to go through there and value that non-controlling interest. You have your proportionate share of net assets method, so we use the reporting date and book value of those net assets. Technically, we will have revalued them to fair value, but that's for later in the session. And then we also can look at it based upon fair value, based upon what the shares themselves and the subsidiary are actually worth. So using S's share price and the number of those shares that the non-controlling interest own. Okay. So that's it. That's your non-controlling interest. We're going to go through and move that on now in the next video and begin to start looking at an asset that hasn't yet appeared, and that asset is goodwill.